Hey, it's John from stopsaving.com, and welcome to the third video of our course, Technical Analysis Simplified, and the first video in this new section on understanding price charts. In this video, we're going to start off by understanding the two different types of price charts, that's line charts and candlestick charts. We'll also explore the information each price chart can give us and how to use that information to make better trading decisions. So without further ado, let's jump in. And here's what you'll learn in this video. Number one, the difference between a line chart and a candlestick chart. 2, how to read and interpret price candles. And finally, number 3, how to read and interpret more than one price candle in a row and what it could mean for the price. We'll start off with the easiest chart of them all, and that's the line chart. So here's a line chart of the Nasdaq 100 index, and that's ticker NDQ in TradingView. Now, this is a one-day line chart, meaning it's a line that connects the end-of-day prices for the Nasdaq. In other words, the last price the index was trading for on each day of the week. Keep in mind that stock markets stop trading at some point during the trading day, and their last traded prices would be the closing prices used to draw a line chart. Of course, crypto markets never close, so if we were drawing a line chart for Bitcoin or Ethereum, for example, we would take the closing prices as of midnight Universal Time Coordinated, or UTC. That's 1 AM London time in the UK summer, and midnight London time in the UK winter. As I mentioned, line charts are the simplest of charts, and they can be especially useful if you're looking for a chart that cuts out the intraday noise. Of course, you can have a line chart for any trading time frame. That can be hours, days, weeks, or even months. You'll notice that for this Nasdaq chart that the line appears to be quite squiggly. That's because it's connecting prices every trading day. If it were a monthly line chart, for example, the line would be a lot smoother, and we can see this on the next slide. And here it is, the Nasdaq 100 one-month line chart. This connects the end-of-month prices, meaning it cuts out any intra-month price noise. Notice how this one-month chart is a lot smoother than the one-day chart from the previous slide. That's because it has fewer price points. Now, line charts can be very useful, but if you're looking to up your trading game, you really need to use and understand candlestick charts. That's because they give you a lot more information about buy and sell pressure than line charts. Candlestick charts were first developed by a Japanese rice trader named Monhisa Homa in the 1800s. And these candlestick charts are going to be your preferred type of chart for trading and investing. And because of that, I'll be using candle charts a lot more throughout the rest of this course. Now, candlestick charts do give you closing prices, just like line charts, and it's really important to focus on closing prices as a trader to filter out the noise. But as I'll now break down, there can be very useful information within each candle that you should also understand. So let's map all of that out now. Here's a green candle, which basically means the price went up during the period. And in this example, we'll assume that period is a day, but it can be any time frame from minutes to months. The bottom of the green candle represents the opening price, i.e. the price at which an investment started trading as soon as the market opened that day. During the day, the price goes up, and the top of the candle represents the closing price, or the last price the asset traded for on the day. So already the candle is telling us that the price finished the day higher than when it opened, which is the same information that you'd get from a simple line chart. But there's more. The candle also has a candlestick, which shows the wick high for the day. That's the highest price the asset got to during the trading day. The bottom candlestick then shows the wick low, or the lowest price it got to that day. So put another way, the candle body only measures the difference between how the price opened and closed, but doesn't include anything outside of that range during the day, which is where candlesticks come in. While green candles mean that the price went up during the day, red candles mean the opposite, that the price went down. And in this case, the open price is at the top of the candle, then the price goes down and closes at the bottom of the candle. Again, red candles can have candlesticks too, and these can represent the high and the low of the trading day. So far we've learned that candles are made up of two parts. There's candle bodies, which show the price action between the open and close, and candle wicks, which show the highs and lows of the period. Now, the size of a candle body relative to the candle wick can actually tell you a lot about the power of a trend. A bigger candle body relative to the wick tends to show that a lot of the price action took place between the open and close, and that means the market is making a clearer decision on the direction of the trend, be that up or down. That's because the candle body shows most of the important price action and cuts out the extreme highs and lows of the day. So here's an example of that. In this full-bodied candle, the market is making a stronger decision about the price. Now compare that to this candle here, which has large wicks on either side, but the price hardly changed from open to close. In this case, the candle is showing indecision among investors, which could be an early sign of a trend slowing down or even reversing. And here's a chart to show this concept in reality. This one is of Solana, ticker SOL, and it's the 1 week chart, where each red or green candle represents 1 week of price movement. Notice the candles in the blue ovals generally have bigger candle body to wick ratios, and those happened when SOL was in a strong trend. Now compare that with the grey ovals, where there was a lot of indecision among investors about whether the price would go up or down. During these phases, the body to wick ratio was smaller, showing a weakening or slowdown of the trend. So let's now look into what we call bullish continuation candles. These are full-bodied green candles that you typically see in a strong uptrend. A bullish full-bodied candle suggests that the price closed closer to the highest price of the trading period. In other words, the bulls finished up strong. So here are a few examples of these. This first one here shows a wick at the bottom. In this case, the price went a bit lower during the trading period, where it opened, but it closed pretty much at the highs, a strong finish from the buyers. And the next one shows a wick at the top. It's a similar thing here, except the price never quite closed at the highs. Still, it closed a lot higher than when it opened, given it's a full-bodied candle. And finally, here's an example with no wicks at all. These are rare, but they can be quite bullish if you see them, as it shows clearly that the price never got below the open of the period, but still finished at its highest possible price. We can explain bearish continuation candles in the same way as bullish ones, but in reverse. In this case, the price closes closer to the wick low of the candle, meaning the sellers were in charge at the end of the period. And here are 3 examples of bearish continuation candles in action. First, a wick at the bottom, meaning the price closes close to the low of the period. Second, a wick at the top, meaning the price went higher during the trading period, but still finished up in the red. And third, a full-bodied red candle with no wicks on either side. These are rare, but show the price never got higher than its open price and finished down for the period. And that's usually a sign that there could be more downside to come. Let's now explain some common indecision and potential reversal candles. While an indecision candle isn't necessarily always a sign of a trend reversal, it can often be an early clue that the trend could be running out of steam. So as a trader, you should pay close attention to these. Now, the color of the candle, be that red or green, isn't always as important as its location on the chart and the candle's structure in terms of its body versus wick. So let's run through 3 examples of common bullish indecision and reversal candles. The first is the hammer, which can be a bullish reversal candle. So remember, for this course, we're trying to understand what's going on in terms of buy and sell pressure. Now, this hammer candle is saying that the price wicked very low during the trading period, but that dip got bought up aggressively by buyers. So much so that the price still finished the trading period higher than when it started it. The second is the inverted hammer. This one is also bullish. Here, the price went much higher during the period, hence the wick, but even though sellers stepped in, they still couldn't get the price to close in the red. And third, the classic indecision doji. In this case, the price moved up and down a lot during the trading period, but neither buyers nor sellers finished up in control. And here are 3 bearish examples. First, the hanging man. In this case, the price dropped lower during the period and buyers stepped in, but the sellers still finished in control. Next, the shooting star. You'll often see these in blow-off tops where the price shoots higher during the period while investors are euphoric, but gives back the whole rally by the end of it. And finally, the bearish indecision doji. These can be an early sign of an uptrend losing steam. Now, I appreciate we've looked at the theory behind a lot of different types of candles, but as always, the best way to learn is to see things in action on real price charts. So I'll now quickly run through a few examples. Here's a bullish hammer on gold for the weekly chart, and another one a few weeks after it. These were clear signs that buyer demand was stepping in at lower prices. And next we have the US dollar index, or DXY, again on the weekly chart. Here's an inverted hammer around the low, showing seller strength as losing steam. And then an indecision doji a bit later on, another sign that buyers were stepping in. Notice the W pattern or double bottom that is formed and how the 2 candles can play into that analysis. W patterns are really important to understand when trying to spot a market bottom, and we'll cover them in a lot more detail later on in this course. Let's now look at some bearish trend reversal candles, starting with this indecision doji on the Bitcoin 1-month chart. Notice how there were 6 green candles before it. It's pretty clear to see here that the indecision doji was a sign sellers were gradually gaining strength. And as for Coinbase stock, here are 2 bearish shooting stars on the weekly chart, showing buyers couldn't quite get the momentum they needed to push prices higher. And finally, here's a hanging man for Bitcoin on the 1-day chart. Buyers bought the spike low, but never had enough strength to finish the day in the green. So we now have a good idea about what candles are and what they can tell us about buy and sell pressure. Knowing this can be super useful as part of your strategy. But when it comes to trading, 2 candles are better than 1. So let's now look at a few common types of candle sequences that can signal a change of direction in the price. So let's start off with the bullish engulfing candle sequence. This can signal a strong change in the direction of price, in this case from a downtrend to an uptrend. So here's the pattern. First, there's a final red candle at the bottom of a downtrend, a showing of strength from the sellers. Second comes the green engulfing candle. During the trading period, the price gets lower than the wick low of the red candle. But then buyers step in with strength, and the candle closes above the high of the red candle the period before. In other words, the price went up overall during the trading period, and power has shifted from sellers to buyers. And here's an example of a bullish engulfing candle for Bitcoin on the 1-week chart. Notice how the price looked like it was about to fall over after the first red candle in the sequence, but things looked very different after the green engulfing candle that came after it. A clear sign that buyers were about to take control. And now for the bearish engulfing candle sequence. This is the opposite of a bullish engulfing sequence with a sudden change in direction from an uptrend to a downtrend. Here you have a green candle first, the final green candle before the trend switches from up to down. Next comes the engulfing red candle, which puts the sellers back in control. The high of this candle is initially higher than the high of the green candle before it. But then sellers come in force and they push the price down so it closes below the low of the green candle. Now the power has shifted from buyers to sellers. So this example shows the US dollar index or DXY on the 1 week chart. And here's the bearish engulfing candle sequence. Notice how the high of the red candle is pretty much exactly the same as the high of the green candle. But even though it technically never went higher, it's still a clear sign that sellers took control at the end of the week, with the index closing in the red, below the low of the week before. Let's now look at a 3-candle pattern called the bullish morning star. Essentially, this is where there's an indecision among buyers and sellers, which is then followed by a new decision. In other words, you get a strong green candle after an indecision candle. And here's what the morning star sequence looks like. First, there's a strong red candle. Second comes the indecision candle. And third, there's a strong green candle to make the decision in favor of the buyers. Note, in this case, the indecision candle in the middle can be red or green as long as it has a small body relative to the wicks. The basic point here is that there's uncertainty between buyers and sellers before the buyers take control in the next candle. So let's now see a real example of this. Here's Ether using the ETH USD 1 week chart, and here's the morning star sequence. Now I'm sure you've probably seen enough candles to be dreaming of them when you go to sleep tonight. But we've got just one more candle sequence before we wrap up this video. And that's the bearish evening star. Just like the morning star, this represents indecision before a new decision. And that comes in the form of a strong red candle after an indecision one. The evening star candle sequence looks like this. First, there's a strong green candle. Second comes the indecision candle. And third, there's a strong red candle to make the decision in favor of the sellers. And here's an evening star in action for Ether on the 1 week chart. This one shows renewed strength from sellers and led to a big drop in price afterwards. So that's the end of this video, and here are the key takeaways. Number 1, a line chart is made up of closing prices only. For example, a daily line chart connects the closing prices of each trading day. 2, candle charts consider movement within each period and give you more information than line charts, and it's for this reason that technical analysts like to use candlestick charts. 3, there are many different types of candles, and there's no point memorizing all the different names. 4, instead, think about what the candles are saying in terms of buyer versus seller strength, and focus on how they close versus the wicks. And finally, number 5, as is the theme of this course, rather than trying to memorize a bunch of terms and jargon, strive for understanding above all else. So that's price candles. Understanding these are essential to trading and technical analysis. In the next video, we'll cover trading timeframes, and that's going to help you decide what type of trading style you want to use, and for roughly how long you plan to stay in a trade. So thanks for watching, and I'll see you in the next video.